Welcome to Stress-Free Investing Analysis Personal Notes.
I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
Okay, let's dive into this. Today, we're unpacking Solar Industries India Limited. We'll be methodically looking at their shift from explosives to defense, checking out their elite financials and forensics, examining their competitive moat, weighing the risks in our bull versus bear breakdown, and finally, getting to the valuation and our final verdict.
Section 1. From Explosives to Defense. A dual-engine growth story. Let's get right into it.
For decades, Solar has basically been the undisputed king of commercial explosives in India, holding a massive 70% market share. But wow, look at this incredible transformation in their Q3 FY26 revenue mix. The high-margin defense segment, it surged to 28% of the pie. That's roughly 714 crores for just one quarter. To put that in perspective, it was just 9% back in FY24. So defense is absolutely becoming their undeniable growth engine here. Now, we still have a robust 40% coming in from international markets, plus those steady multi-year contract baseline revenues from coal, India, and infrastructure. But man, that defense pivot is truly staggering.
And all of that growth, it builds incredible future visibility. They're sitting on a massive order book of over 21,200 crores. That is equal to nearly 3 full years of guaranteed revenue based on their FY25 numbers. It gets even better though. Over 15,200 crores of that total is purely defense. They are completely locked into major, long-term contracts for Pinaka multi-barrel rocket launcher ammunition, Nagastra loitering munitions, and 155mm artillery shells. I mean, they are locked in.
Section 2. Elite Financials and Forensics, the cash printing machine.
So, does the balance sheet actually back up all this growth hype? Well, yes. We ran them through some rigorous forensic models, and Solar passes with absolute flying colors. And this brilliantly illustrates why. Their Piotrowski F-score is an 8 out of 9, which indicates immense fundamental strength. Then you have the Altman Z-score sitting at 36.5, putting them firmly in the safe zone with zero financial distress risk. But the real star of the show here is that Benish M-score of negative 2.55, which proves their earnings are totally clean. Translating this into plain English for you, it means their cash earnings actually exceed their reported earnings. There's no accounting magic happening here, guys. It's a genuine cash-generating machine with a near-clean bill of health.
Now, I really want you to feast your eyes on this number, 38.1%. That is their return on capital employed, or ROCE, over the trailing 12 months. To put that into perspective, this is almost 3 times their estimated cost of capital. They are creating immense value for literally every single rupee invested, placing them right in the top decile of Indian-listed companies. And you know what's even more impressive? They're doing all of this while remaining virtually debt-free. They boast a microscopic debt-to-equity ratio of just 0.06. Just incredible. If we walk through the steps of their FY25 financial inflection, the cash flow waterfall makes this crystal clear. FY25 was a true quality inflection point for them. Step 1. They achieved a record 26.9% EBITDA margin, heavily driven by that higher margin defense and international business we just talked about. Step 2. That translated to roughly 1,700 crores in operating cash flow. And Step 3. Even after significant capital expenditures, they still generated 1,462 crores in pure free cash flow. They aren't just making sales on paper, they are converting revenue into massive tangible cash.
Moving on to Section 3. The competitive moats. An insurmountable lead.
You might be wondering, how does Solar protect these elite financials from competitors? Well, the answer lies in 5 deep competitive advantages. Let's fire through them. First, regulatory licenses. Getting Ministry of Home Affairs approvals for explosives is no walk in the park. Second, highly guarded tech agreements with the Ministry of Defense and ISRO. Third, massive switching costs. Military and mining qualifications literally take years to secure. Fourth, immense global scale, operating across over 90 countries. And fifth, ironclad 30-year relationships with foundational clients like Coal India. No other domestic peer, not even Premier Explosives, which is roughly 1/40th of Solar's size, has this unique combination of an explosives monopoly and early mover defense manufacturing at scale. It's an absolute fortress.
Section 4. Risks and bull versus bear. Weighing the scales.
Now, every great business faces risks. And to be totally objective here, we have to weigh both sides of the scale. On the bull side, the tailwinds are absolutely undeniable. India's massive defense build-out, a margin re-rating as defense becomes a larger slice of their pie. That massive order book we saw. An aggressive international expansion. It sounds great, right? But on the bear side, we really have to acknowledge severe execution risks. The company guided for 3,000 crores in defense revenue for FY26. To actually hit that, they absolutely must execute their massive Pinaka deliveries by Q4. If they miss those delivery targets, the market will punish them for sure. Furthermore, they face price volatility in ammonium nitrate, which is their key raw material, and well, they are currently trading at an extreme valuation multiple. Which brings us to Section 5, Valuation and Final Verdict. The elephant in the room. Let's transition from those exciting fundamentals to the somewhat sobering reality of the market price. So the crucial point here is a 99x trailing PE ratio. At this price, the stock is completely 100% priced for perfection. The market is demanding flawless execution of their defense ramp-up. At 99 times earnings, there is literally zero margin of safety if a delivery gets delayed or margins slip even slightly.
Let's map this out using a 3-scenario analysis based on the current price of roughly 15,512 rupees. In our base case, assuming they hit all their targets perfectly, the fair value is around 16,000 rupees. That offers a mere 3% upside. Now, if everything goes absolutely flawlessly and exports accelerate, the bull case points to 21,500 rupees. Okay, not bad. But look at the bear case. If defense deliveries are delayed or growth slows down, the target drops to 10,500 rupees. That is a steep 32% drop. So the risk-reward at the current price is simply not in our favor right now.
Therefore, the sweet spot we are keeping our eyes peeled for is this target range of 13,000 to 14,000. If you can exercise some patience and wait for a 10 to 15% dip from the current price, it transforms the risk-reward ratio entirely. Suddenly, your downside is protected, and the setup becomes highly asymmetrical and incredibly attractive for a long-term compounder.
Bringing it all together, our final verdict for this explainer is accumulate on dips. This is a perfect company at an imperfect price. Solar Industries is undeniably an A-plus quality business, generating elite returns on capital and compounding earnings at a rapid 30%. The multi-year defense story is real, but as disciplined investors, we have to protect our capital and wait for the right entry point to capture that alpha. The ultimate question you have to ask yourself is this: will their massive defense execution justify this astronomical valuation, or will gravity finally catch up to the stock price?
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI's registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.